Hello everyone, today is Friday, October 8th, 2021. My name is Evan. Welcome back to our weekly stock market analysis video, episode 600 this week. Nice round 600. Can't believe I've done this many videos up on YouTube. I think back in the day I used to publish on Vimeo and other assorted places. We used to do these more than once a week, so that's why that number got up there pretty high as well. Used to do 2 or 3 of these videos a week. But episode 600, thanks for all of you that have been following along and kind of tuning in every week along this journey, kind of measuring, mapping, figuring out what's going on in markets. And for all of you who are brand new, which we get new viewers, new subscribers every single week. Let me break it down for you, kind of tell you how these video series works. We break up our analysis into 2 parts. So in part 1, we look at things like volatility, credit markets, correlations, market internals. We go beyond price and we look at some of the more important data and related markets. And then in part 2, we jump into the charts. We try and make some sense of price action and trends and how to best position ourselves looking ahead. So hopefully that sounds good to you. Let's jump into some of the headlines from this week. We had sort of the big takeaway in terms of equity markets. We had the September support hold. So we saw a good battle, a good fight take place this week at the range we've been talking about. We're going to look at this in just a moment in much more detail, but we've been kind of slogging it out at the September lows, and we did get that bounce. We closed green in most of the markets this week. So I think, you know, the war is not over here, but at least this battle, the bulls have initially sort of won, and lots of context we're going to talk about a little bit later. Interest rates continue their move higher, so that is, you know, good and bad. Interest rates by itself is not necessarily bad that they're rising. It depends how fast they rise. I mean, you know, inflation, as long as growth can keep up, I mean, interest rates going up, you know, paves the way to, you know, inflation, and that can be okay, obviously, as long as we have enough growth to sort of offset it and, you know, go down into the weeds here. But basically, you know, a lot of what we do is measuring really just price and how these markets are responding rather than trying to, you know, think about the economics at play. But it's good to have a handle of kind of where things are going and what the macro environment looks like. And that's kind of the developments we have going on right now. But all is not lost, because we do have 2 sectors hitting new year-to-date highs, and that is financials and energy sectors. So both of those, if you have been invested in those areas of the market, then you are pretty happy after this week. So we're going to talk more about those later in this video as well. Let's take a look at performance here. Right-hand column, you can see the 1-week numbers. Like I say, mostly green across the board. The Russell 2000 couldn't keep it together, closed down just slightly, but the Dow Jones very much in the lead here this week, over 1%, and everything else kind of followed behind. If we take a look at market internals here, we started to get a little bit of life into the end of the week. Remember, these numbers started to get real low here, single digits into the end of last week, mid last week, and we were sort of teetering around the 0 line here. I'm talking about the first row, which is the 52-week highs minus lows. You can see we did, you know, kind of accelerate higher a little bit. Remember, Friday's numbers are estimates. I don't have the final numbers at the time of recording this, but generally speaking, we're hanging in there. And so far, the buyers, the bulls are, you know, making a stance around these levels. If we take a look at the AD line down here, again, you can see it's very thin, but still positive on the week. And then take a look at the percentage of S&P 500 stocks over 20 SMA. We're starting to see that nice rise here, back over 50%, kind of at the midpoint going into the weekend. So if we take a look at those market internals, those 52-week highs minus lows, this is what the picture looks like, and it's no longer a sort of rip-roaring uptrend. I mean, we still have a few days left, but after this week, you know, we're going to be much more gradual here, and this goes to show you just the real sort of slog back and forth that we've been seeing in the market. And the, you know, kind of underlying message here, though, is that there are still incrementally slightly more stocks that are hitting new 52-week highs than there are stocks making new 52-week lows. And that, to me, is a good intermediate term sort of judgment on how healthy this market is. So continues to favor the bulls right now. We're going to continue to monitor this, but like I say, it is thin but still holding. Moving on to sector performance this week, you can see most sectors finishing in the green here. Again, we're looking at this right-hand column. This shows you the 1 week change. Top two sectors, energy, financials, both of those again closing to those new highs for the year. Industrials in the third spot. That's why you're seeing the Dow Jones act so strongly this week. On the downside, we did have three sectors in the red. We had real estate, we had communication services, and we had healthcare, both or all three down about about 0.5% more or less between the three of them. If we take a look at correlations here, so a couple of things to take note of, or at least some of the stronger inverse correlations that I'm noticing is first the dollar. So if you look at where my mouse is here, middle of the screen, UUP, that's the dollar index. And you can see it's negative inverse correlation to everything that looks like an equity. So all the equity markets here, all the US averages, well, and international, ACWX, is inversely correlated. So as the dollar goes up, the averages go down. And so you're seeing that relationship continue to kind of play itself out. Notice the 10-year yield, and this is all, everything's related. And that's what's so fascinating when we start to drill into all of these different markets and asset classes. But the 10-year yield here, which usually sometimes will have a strong grip on what the market is doing, doesn't really have too much of an effect, at least right now, and at least over the past 10 trading sessions. That's the way we're measuring it. The other fun fact here is look at Bitcoin down here. So negatively inverse correlated to the equity markets as well. So, who needs to hedge with VIX or buying SPY puts? You can just buy Bitcoin, and that's what's been working in the opposite direction of stocks as of the past 10 days as well. So again, don't actually do that, please, because that's probably not going to hold up, but it is fun and interesting to see how that's playing out right now. If we take a look at VIX and volatility term structure, you can see this was a positive this week. We're back below 20 here on the VIX. That's a good, just psychological level, frankly, good expression of where fear is in the market. To be back into the teens is kind of always a good thing if you want to think in the terms of being bullish anyway. If you're bearish, then obviously you're not so happy. But, if you're generally looking for stocks to go higher, it's nice to see the VIX finally get back below 20. Let's see if it can stay down here this time. In terms of its term structure, looks pretty, kind of classic here. Maybe a little steep, but not going to look too closely at that at this time. If we take a look at interest rates and credit, so again, this is one of the core key takeaways from this week, is we did continue to see a pretty sharp rise going on here in yields. And again, it's the magnitude or it's the momentum behind the move that is very important too. So we are seeing yields continue to rise, continue to break out. They're not going back to year-to-date highs, or they're not there yet. They could get there, but we are, certainly still seeing this move play itself out. If we look at bonds here, and obviously these are related, but this starts to get slightly concerning if we continue to see LQD and JNK break down here, and you're seeing now the 1 month changes go negative for both of these ETFs. That to me is gets to be slightly concerning, and it's a little semi one-dimensional view here, but it's a very easy at a glance proxy, and you don't necessarily want to see these continuing to get hammered. I think they closed at their lows for this week, and that's just generally speaking not a good thing. You'd like to see them kind of lifting up pretty much in line with stocks. So this to me is something that I don't like that has developed this week, and so let's keep that in the back of our mind as we go through the rest of our analysis. If we take a look at dollar and commodities here, you can see the dollar was pretty much flat, slightly up. Gold was down, silver was up, both pretty flat. Bitcoin up pretty substantially this week, 13%. And if we look at crude oil and natural gas, still both up as well. Commodities continue to work in this environment. Again, this kind of inflationary tone. You've got interest rates rising, banks are doing well. You got commodities that are going up, enjoying this sort of move up as well. So this is the sort of areas or pieces of kind of the global market that is working right now. If we take a look at the report card, all things considered, it was a pretty constructive week. We did have equity market performance working. We had market breadth support. We had some risk sectors out there performing and leading. Volatility environment, even though it did improve, still not great, still not in that ideal sort of zone yet. And if we look at credit markets, this is definitely a big X here as well. So report card, give it a B for this week's performance. That's what we're going into the weekend with. If we take a look at how we've been handling it here internally, so we're running two trading systems, Merlin and Lamerick, and I think what you'll notice, especially if you're looking at these week over week every time we post them, and we do post more detailed monthly trading reports on our website as well that go more in depth than just the snapshot, but we actually have more cash on hand than we have had in a long time, even though our longer term system here, Merlin, is still 90% invested, which obviously is pretty significantly bullish or involved in this market. It is holding 10% cash. It's not putting it immediately back to work. So for the first time in quite a while, we're actually seeing a little bit of hesitation here from this top system. We haven't seen that in some time. Typically, it gets cash and then it just puts it right back to work. And so it's hanging on to some cash. We'll see how long that lasts, but that is notable. Then, of course, our short-term system down here is, mostly cash, right? It's down to 3 positions, 23% invested. I think there's actually a short position on deck for Monday if I looked quick. So this one's getting much more tactical here. So kind of the new developments there. And, obviously, both of these trading systems are operating on totally different time frames and factors that drive their decision making. So that's what makes things pretty interesting. If you want to learn more about these systems, take them for a 14-day free trial. Check out our performance first. You can see everything posted transparently for this year, last year, the years before. And we have those 14-day free trials available at the link appearing in the top right of the screen. We'll be back here in just a second with some charts. All right, we are back here. We've got TC 2000 open. We've got our equity market grid we're looking at. We've got our smart trend filter. So these are the multicolored dots you see on all these charts that measures price volume across time. It's a very simple heuristic for trend strength, path of least resistance. If you're a TC 2000 user, or if you're a TradingView user, you can get this indicator from our website to analyze charts, ETFs, and everything that you want to look at. And price itself is the white dashed lines you see. Now, we're looking at a weekly time frame, and we've got some things to talk about here. So again, this weekly time frame is slow. It's long-term in nature. Trends last quite a while, and you can certainly see that by all of the green dots you see printed here going back over the past almost 12 months now. But if we take a look at the S&P, for instance, we see that we started getting some yellow dots printed in here over the past 3 weeks. And what that basically tells us, and this is kind of the benefit of this trend model, is that it tells us that there's turbulence now. There's cross currents, there's conflicting signals, and it's not a sell everything, let's get bearish and run for the hills. It's simply a point at which you want to take notice. Maybe you want to take some discretionary action. Maybe you want to drill down to a lower time frame. And that's what those yellow dots tell us. We basically still say you should give the benefit of the doubt to the prior signal. And so in this case, kind of glass half full, S&P 500 prior signals green, trend models still on that uncertain level. So we're seeing that for the 3rd week in a row. Nasdaq, 2nd week in a row. Russell 2000, a 1,000th week in a row, because this has basically been the state of it all year long. And so as this range continues to move sideways, we're going to have a big breakout from this. It's just going to be a wait and see on which way this ends up going. But for now, it's still glued to the middle. And in the bottom here is a first sell signal we've seen on a weekly time frame in quite some time for this isn't US markets. This is everything but the US. This is world minus US. So this is the ACWX index ETF. And the last time a sell signal was printed here was back in COVID peak, which was, or at least COVID start, around the March, April, May time zone of 2020. So very interesting here that we're getting a confirmed transition lower here, and a trend break to the downside in international stocks. Going to be very interesting to see if this spills over to anything else. but you certainly have that signal there on the weekly basis. Let's get a little bit shorter. Let's go to a daily time frame, and this is where markets are a lot messier here. And again, we've got some interesting things to talk about because the S&P 500 on this daily time frame has been choppy to down since, mid to late September. So nothing really new here. We've essentially known, if you're looking at this again, simple trend model, that the S&P 500's been in a tough spot for the past 2 to 3 weeks. Nasdaq, same thing, going out on Friday, both in yellow signals, but the prior signal's red. So again, we want to be a little bit cautious. You can see the S&P 500 trying to get back above its trend signal, but it's still, waiting and seeing mode. Look at the Russell. This is kind of curious here because this actually had enough strength on Friday to print this green dot into the weekend. So this is very interesting here. I've had sort of this belief that we could get the Russell 2000 to kind of lead us out of this mess if we can get out of it. That's kind of where my intuition is pointing me. Again, I'm going to wait on signals and my models to tell me that on a definitive basis, but that's been my hunch here. And I'm wondering now if this is an early indication of that. Obviously, the performance this week on the Russell was underperforming relative to the other averages, so it's still way too early to claim any type of victory here, but it is interesting that we're getting an early transition up. And if we look in the ACWX, the bottom right here, you can still see, again, pretty much a messy market. So now that we kind of have our trend models down and we've got our time frames differentiated, let's go to some candlestick analysis here of this action. And if we look here at the S&P 500 to start things off, you can see this was the battleground. Did some videos throughout the week on the YouTube channel as well, and posted a couple of charts on social. But this was essentially the range that we were looking at. This was the battleground that was taking place between 4,300, 4,360, 4,370, this general zone here. You can see all the overlapping sessions, gap ups, gap downs, big ranges throughout the days. And we ultimately had what ended up being, if you looked more on the SPY ETF, you'd see this nice bullish engulfing bar here on Wednesday. Then we had the nice gap up on Thursday, but a pretty bad close. And then Friday, we kind of got this semi-ominous looking bar as well. So it's kind of a bittersweet because we did see the buyers, the bulls, step in, defend 4,300, defended the September lows. They stepped in, we rallied us off of the lows. But now we're kind of just meandering here. We're not just ripping to the upside. We didn't go into the weekend closing at highs with another third day up. We closed towards the lows and it was more lackluster. So it is tough to call a victory lap. This market is still difficult here, chopping traders up. And when we, kind of clean up the levels here, if we're just going to try and go to a clean slate, you can see that we really, again, ultimately want to stay above this 4,300 zone. That's obviously a critical intermediate term line in the sand. You don't want to see SPY back below that. So 4,300 is kind of the no-brainer level. But, for me, when I look at this price action now, we've got this open gap on Thursday. What I basically want to see is this market put in some type of higher low, ideally below 4,350. Come in next week, maybe we can get a quick gap fill here, but I just like to see support kind of be made and form over this 4,350 area. Don't come back down to the bottom end of this range, put in some type of higher low, and then move to the upside. That's, to me, a very, very bullish, healthy, and constructive path that this market could take. Obviously, the market cares, a big zero about what I want to happen. It is just the path that I would like to see, prefer to see in terms of the bull case. Generally here, if you're looking more or less at any of these down-sloping trend lines, draw them however you want. Doesn't really matter to me. But, again, just breaking over this band of downward selling pressure that we've been in here is what you essentially are looking for. If we look here at the S&P 500, for instance, you can see, or the SPY ETF, we typically see turning points occur at heavy volume occurring at turning points. And you did get that peak in volume here. You did see that volume accelerate on this, sort of these sessions right in here. So this chop right in here. You also got a nice volume peak in here. So again, the fact that we saw that volume peak, we're starting to taper off, we're starting to move away from it, that could be, again, good signs that we did at least flush enough and sort of, cause enough pain for some of the bulls to start moving higher. So that's kind of the way I'm looking at this. We'll see how obviously we shake out next week. If we come slamming back down, start breaking down below 430, all bets are off, and then things could get much more ugly. If we look at the IWM, we talked about its trend, the fact that it's gone nowhere over the past year, but in the short term, it's just clinging on to the middle of this range. So again, what we're looking for here in the IWM is just basically to lose grip on this magnet of 220, 225, which we've been trading in forever. You want to see this launch above. You want to see us get out, break out to the upper end of this range. Thought we were going to get it here, seemed promising, and then we had this ugly kind of gap down, and then that proceeded to just go through all this chop. So again, we're looking for another candle that looks like 927 on September 27th. The difference is we want follow through and we want it to hold, right? That's what we're looking for. So IWM, still waiting for that to kind of play itself out. And then if we look at the Nasdaq 100 here, it's very similar to the S&P 500. This sold off more than the S&P 500, and this, arguably looks slightly worse in terms of its structure, but you still have similar ingredients here. You've got these high volume potential turning point type of sessions, and you're basically looking now for price to hold, for price to get off of the recent trading lows and to put in some type of higher low over, let's call it 357, 358 or so. Quick gap fill, put in that higher low. That's the ideal path. Again, you still have all of these downtrends that are very much in place and these lower highs that are very much in place. So we've got work to do to break out above this downtrend line. That's the way I'm viewing price action. And until we break out, then, for depending on who you are, what type of trader you are, you may want to be more sideline, more cash, just waiting. You don't want to deal with the volatility. That's totally fine. But if you are more tactical, if you like the volatility, then, indices are in play and you can be tactical and short term and, take advantage of some of this chop. So that's kind of the way I'd like to think about it. And hopefully that's helpful. Let's jump into some of the other markets here. If we look at VIX, which we talked about is back below 20. That is good, right? That's encouraging. The fact that VIX went out at lows, I like that. The fact that VIX found highs up here around 2450, but never broke back out over this September peak, that's good too. That's constructive. So again, there's a lot of mixed signals in this market right now, but I like the fact that VIX looks like it wants to roll over a bit. If we take a look at TNX, which is our 10-year treasury yields, you can see that those continued to break out pretty sharply here this week. And so again, this rising vertically is going to put pressure on anything with those long-term durations, with technology stocks, with things that are pricing growth way out into the future. They're going to be under pressure, and the Qs are not going to like a TNX that's going vertical. So we have to be careful here on what this looks like. The highs of the year for yields are around 1750. It kind of looks like we're getting back up there to retest that zone. And if we just cut right through that, that's going to be a little bit of an interesting dynamic and scenario for this market to digest. So let's keep an open mind and keep an eye on these markets that certainly can spill over and impact what equity markets are doing. If we look at the US dollar, this has been, kind of hanging out here. It got back up to highs, so it broke out to fresh highs last week, but it didn't make any new progress this week. That's, probably a good thing. Again, I don't think you necessarily want to see the dollar just rip to new highs here, because it just has implications right down the domino effect to equities. So UUP, dollar index, let's see this kind of settle out. TNX, again, settle out. Those two things I think would be good for, your traditional kind of growth stocks and tech sectors, semis, all that fun stuff. So let's go to commodities. This is, certainly an area of the markets that are enjoying this landscape. So we're seeing USO just continue to move higher here. Big volume. It totally left behind this consolidation that it put in, started in July, took 2 months, corrected about 20%, I believe, 16%. And it basically just went, pretty vertical here. It just cut right through the highs, and it's just trending again. Momentum MACD is back up at highs. Natural gas obviously been having a big move. It's cooling off most recently, but heavy volume coming in, and that's certainly interesting. If we finalize with a couple of sectors here, financials. So we talked about them. Financials loving the higher interest rates as they get slightly more margin on their business model. So they're closing at highs here as well. And we've got energy stocks, which are just now getting back up towards those highs. They've been consolidating for a while, and they are making new highs. So two sectors that are working. Let's actually take a quick look at our sectors and industries this week. Yes, you can see energy and financials on our scans here, both on the bullish of interest. Take a look at, again, oil and gas industry here, banks, industry, oil and gas. So you got aerospace, airports, right? Financials, insurance, and staffing. So very much fits kind of what we would expect. On the downside this week, it's, got some biotech and healthcare. This has been a tough spot to be. New lows here for biotech. Grocery stores back down towards support lows. Luxury goods, not too much. Closed at the lows, but still just consolidating. Medical, right, down again. We see, again, consumer defensive back into this sleepy range here. And then pharmaceuticals, defensive, still, again, back to these recent pivot lows. So that's what's working. That's what's not working in this market. And of course, we've got lots of different signals out there. So leave a comment below. I'd love to know what you are thinking about for this weekend. What's the plan of attack? What's on your mind? Are you constructive? Are you believing in this bounce? I think the majority of feedback I heard last time I asked this question was no. And we got a little bit of a bounce, but again, we're not out of the woods yet. So let me know what you're looking at this week in the comments below. And I hope you have a great weekend. We'll be back next week. Got a new podcast coming out Monday. Got some new content later on in the week. So have a good week, and we'll see you back here next week.